great to see you here. I'm glad there are some people here. When we began the idea of organising an event on ethical investment, a contradiction in terms, I must say I wondered whether or not this would attract anyone at all. Since I think lots of people have difficulty reconciling the whole issue of money and ethics. So that's what we're going to be talking about tonight. And we have four very capable and thoughtful people to contribute to this evening's discussions. Garry Gould, Simon Brodie, Margaret Galt and Mark Richards. And we're going to proceed with presentations from each of these speakers and then have probably a minute to stretch and sort out sore backs, Margaret, and then an opportunity for questions and discussion. And I hope we can have some lively discussion and interaction among the panel members. Having seen their presentations, I'm conscious that there are going to be some different strands and potentially some differences of emphasis, which I think is really important and will bring out some of the really hard choices that we face as we seek to be stewards of the resources that we have available to us. So thank you very much for your willingness to come tonight and contribute to this forum. We look forward to what you have to say. And Simon, we'll begin with you. Thank you very much.
Okay, thank you, Jonathan, and good evening. There's a lot to get through, and I'm conscious there's four speakers, so I'm going to rattle through this.
Would you be able to use the microphone for the recording tonight? So.
Oh, are you? Okay. All right, so I am going to try and rattle through this because, as I said, there's a lot to get through, and we've got a few speakers. So straight to the agenda. So, is ethical investment a contradiction in terms or an oxymoron, as some folk like to say? The global financial crisis, or GFC, is it evidence of an improper relationship between ethics and business, and specifically greed? One hears that a lot. What are its causes and consequences? And a good question, is it fair that the consequences seem to include, or do include, the privatisation of profits and socialisation of losses? In New Zealand, how do we rationalise our property experience, the collapse of the finance companies, that's our form of the GFC? And finally, where one has ethical guidelines in an investment strategy, do they actually make a difference? So let's go to the first topic, as ethical investment, a contradiction in terms, and let's try and simplify that into two reasonably accepted theories, being shareholder theory and stakeholder theory. So let's look at shareholder theory first. And this is a statement from Milton Friedman, and he says, there is one and only one social responsibility of business to use its resources and engage in activities designed to increase its profits. What that infers is that businesses should maximise their profits for shareholders, subject to the limits of the law. And there's really no obligation to go any further than that unless it is consistent with that first objective. What that means is that business ethics are indefinable relative to ethics in general, and therefore any attempt to incorporate ethics runs the risk of a suboptimal outcome, the effective imposition of a tax, maybe even the misallocation of resources. Now, if we assume that social and environmental objectives are defined by elected governments, then profit maximisation at the corporate level optimises those human welfare outcomes via the elected government process and the redistribution model. So that's all pretty straightforward. Now let's look at stakeholder theory, which says a business should be managed to achieve a balance amongst the interests of all those who have a material relationship to that company. That sounds good. The issue, though, is what does it actually mean? What's the boundaries? How do you define and measure them? I suspect if I was to ask everyone in this room what that meant, I may well get as many views as there are folk in the room. Not that there's anything necessarily wrong with that, but what it does mean is that behaviour, activity, intentions will be judged differently by different people. And at the end of the day, if something is hard to define, it's hard to measure, it does tend to lose a bit of persuasiveness. So can we make any progress? Where does business ethics really fit in? The way we view it is in determining how far one goes in meeting that profit maximisation objective. Now, Friedman said or inferred to the limits of the law. There is an issue with that, however. Pushing anything to the limits of the law or pushing anything to its boundaries increases risk. Now, there can be a positive outcome from that, but what we're concerned about is a negative outcome. Negative unforeseen circumstances, instances of market failure, negative social environmental consequences, and maybe when all the dust is settled we get some suboptimal policy responses. Should we care about that? And why should we care about it? Well, we should because it threatens both those shareholder and stakeholder objectives. The shareholder one both from the point of view of the monetary gain, but the value associated with that gain. So there's a wealth effect, i.e. if we increase the risk premium associated with the monetary gain, all things being equal, it is worth less. While we're on definitions, what is the difference between morals and ethics? The way we view it, morals are defining personal character or beliefs of what is right and wrong, and ethics a social system in which those morals are applied. So, for example, where the board chooses to not have any exposure to, say, for example, pornography, that reflects a moral view that pornography is simply wrong. So, is it a contradiction in terms? The short answer is no, but assuming that you can precisely define it is, I think, a little misguided. And it's easy to be a little cynical. Some of what passes for ethics, I think, ends up being philanthropy or really part of the marketing budget. In other words, profit maximisation in disguise. It's interesting when you look at business ethics and literature and how it gets taught. It tends to reflect this notion of continuous improvement or and a tug between is it mainstream or non-mainstream. All right. In other words, it's work in progress, but there's nothing wrong with that at all. And really, ethical investing becomes an opportunity for risk-adjusted profit maximisation. That's a big mouthful. Where social outcomes are also optimised and where the risk of an extreme negative outcome is reduced. And that is compensation for any incremental cost that's involved. So that nicely leads us into the GFC, which is a negative extreme outcome, if ever there was one. Right, how did we get in such a terrible mess? We think the causes are relatively straightforward. It's the scale that's the problem. The scale is unprecedented. No one in this room will have seen anything like it before. There's no doubt that ethics and greed have been contributors, but they are certainly not the only factors. It is far more complex than that. The consequences, I've said there, could be very, very nasty. Arguably, if you are a resident in Spain and Greece, they are already very nasty, but it could get a whole heap worse. No question about that. We are in uncharted waters and approaching the sharp end. My own view is 2-3 months ago, maybe the authorities were reasonably in control of what's going on. I don't think we can say that right now. Let's try and put the GFC in some sort of perspective. This is an oldie but a goodie, this chart here. It's usually headed up fear and greed, and it measures emotions in the investment cycle. So it shows the movement of price around the fair value of an asset, and I would invite you to read the captions. Okay. Now, as I said, this chart is usually headed up fear and greed, but that is an oversimplification. It is also all of that. Now, we are complicated animals. First of all, we are risk averse. That means we are far more affected by losses than we are equivalent gains. That is made worse the more frequently we look at our investments, which is myopia. And that leads to something in the trade that we call do-something-itis. The more often we look at our investments, the more we think we should do something about it, even though 99 times out of 100 we should do absolutely nothing. We tend to be overconfident, overestimate our abilities. We're all better than average drivers and investors. And we love to herd. We love to be part of the crowd, do what the crowd is doing, even though most or many professional investors make their living by doing precisely the opposite. We're all guilty of laziness, ignorance and error, making mistakes, and sometimes it's not greed, it's just simply hope. So it is a oversimplification and a convenience to just label our problems greed. Right, the build up to the GFC is pretty straightforward. Up here we have US inflation peaking at where it is in the early 1980s. It falls and it goes along reasonably stable. That led to this notion of the Goldilocks economy, not too hot, not too cold. That then enabled us to go to, we've beaten the economic cycle, we do not get booms and busts anymore. And then unfortunately it led to the notion, well, if we've beaten the cycle, then we've taken some risk out. If we've taken risk out, or volatility in jargon terms, then the cash flows that come from that economy must be worth more. Wrong. Now you can see what happened to interest rates. After that had been bedded down, interest rates have managed to fall for an awful long time now, producing one of the largest bond markets in decades, rallies in decades. What happened to shares? Well, we managed to create the largest equity bubble in history. But let's look at what really happened. This shows you the returns to US shares from the 1880s through to 2000, or currents, in decades. And what I've done is I've split the return up so that you can see what's actually been going on. So that's split in three parts. The first part, the red bar, is the dividend yield. You know that when you buy a share. You get some earnings growth, that's the grey bar. And the last part, the yellow one, is the change in the PE ratio. Okay, that's jargon. What that means is the amount that you're prepared to spend for $1 worth of, say, telecoms earnings. So if you're feeling full of beans and optimistic, you might be prepared to spend $20 for every $1. If you're feeling not so good, maybe $5. Now, over at the right here, we have an average of all of that. And you can see that most of the return comes from dividends and earnings, and only a small contribution from the change in the PE ratio. But over shorter time periods, that change in the PE ratio is very volatile and tends to dominate the short-term return. And as you can see, here's our linkage with that price chart that we saw earlier. It goes up and down depending on our emotions and our expectations. Now you can see what happened in the equity bubble. All we did was we were prepared to spend more and more for $1 worth of earnings. We got quite silly. And now you can see when we got the bubble bursting, what's happened subsequently. The market has taken out, or trying to take out, that nonsense that went on here. So it all makes sense. There's no mystery to what's been going on. When the bubble burst, we had a problem, or the authorities had a problem. All the debt was in the corporate sector. Rather than restructure that, which usually means people lose their jobs, which is not good for politicians, what the authorities decided to do was to lower interest rates and buy corporates time to recover their balance sheets and not put people out of work. That's all well and good. It left you as the investor with a problem. You hated equities because they'd just crashed, which was irrational, by the way, and you didn't like what you got for being a defensive investor by investing in bonds, because you didn't get anything. So what we did was we went into hard assets called houses and created the largest equity bubble, property bubble in history. This shows you US houses from 1890 through to 2005. You can see in 2000, straight after the equity bubble, it goes vertical. Right? You don't need to know anything about the economics of housing to know that that looks nuts. And that's what happened. We had a bailout, and I think this cartoon just about says it all. I'll say more about the bailout in a sec. Now, this cartoon, Jonathan's giving me the hard word. I need to hurry up. This cartoon is not funny. It's very serious. So this is a boardroom table, and the chairman's saying, I understand we own 1 billion of CDOs, just regard that as a product designed to give you high income. Question, what is a CDO? Now, it's at times like this that I'm tempted to blame everything on Alan Greenspan, so just a couple of comments here. Yes, Alan, securitisation should reduce risk, But if the asset is hideously overvalued, we have a problem, right? And when you come to clean it up, we've got a bowl of spaghetti, and we've got no idea where Mrs. Jones' mortgage is, or if she's going to default or not. That's the first point. Second point, the assumption made was that these, let's just call them fat cats or whoever you want, whatever you want to call them, are incentivised to look after themselves, and by doing that, they look after the company. That's the theory. So all the incentives are right. Problem is, you can't protect yourself or the company if you don't know what's going on, or you're not paid to know. And it's very hard not to do something when the guy down the road is doing it and making money. And don't forget that you've got me and you on the sidelines saying, where's the performance? On a monthly or quarterly basis. Short-termism is an awful problem. Right, I'll restrict my comments on the GFC in New Zealand to New Zealand property, so just a couple of observations. Property is not special. It does obey the laws of finance, eventually. So US prices are down 30%, Irish are down 40%, Spanish 30, 40 going down to 60 probably. That means the key risk is price risk. If property goes up, that's good, but it's also bad because it increases the risk that you overpay for the asset. Why do we take massive bets on one asset class, or even just an asset, that we wouldn't remotely consider with any other? And if you think about it, it's a very expensive way of investing once you take fees into account. And let's assume you've invested in a property and you get a net weekly income of $350 and it grows at 3%, your required rate of return is 9%, it is only worth $300,000 roughly, no more. Okay? For 1% rise in mortgage rates, you lose $40,000. And here's the real question. What if they showed the price of your investment on the TV every night? How would you feel about it then? How would that change your behaviour? So it didn't matter if you owned 2 or 20 investment properties or finance company debentures, you were not diversified, and yes, there is no such thing as a free lunch. You may have noticed in the last few weeks there's been quite a lot of chat about maybe New Zealanders or Kiwis are getting more interested in property. Prices are down a bit, and the share market doesn't look too crash hot. These are two charts that you very rarely see in New Zealand. It shows price to rents, in other words the PE of houses, and price to income, in other words your ability to pay down your mortgage. Started in 1975, but as you can see just in the US it shot up in 2000. Now that is just crazy stuff. All right, and this places New Zealand in the top 5 or 6 worst countries in the world. So the message there is price to value. There's been a bit of progress, but not much. Right, privatisation of profits and socialisation of losses. The basic problem here is rolling investment bubbles and policy mistakes. We've had a rise in Asia emerging markets, and that's caused a fall in Western living standards, and governments have tried to overcome that by deficit spending. End of story, really. It doesn't help if you get the internet and EZL giving us those bubbles. The debt problem has gone from the corporate sector, where it does not exist anymore, to the households and the finance sector, the banks, and now the authority or the central banks. So yes, the taxpayer is on the hook. Now, the authorities have made a choice. Just as they did in 2000, they have chosen to bail out the too big to fail institutions rather than restructure them, and the consequences that follows from that. Your average CEO around the world is now sitting on a wonderful balance sheet with tons of cash, but they're not investing. They don't like what they see either, and they're not incentivised to. So capital is finding it hard to find an investment return. So what is it doing? It's speculating. Successful speculation requires skill, and usually if you're engaged in that, you get a decent salary and you probably get a bonus. But there's far less people doing that now than there was a wee while ago, tens of thousands less. And of course what we have is the 1% getting targeted and vilified, and there's a few urban myths in there, by the way. Yes, you can't cure debt by more debt, only growth. The problem for the authorities is it's not working. All right? Austerity doesn't fix it. The authorities well understand that as well. It's a means by which you can buy time, really, and hope that it starts to work. And there's nothing wrong with austerity. It's got a bad name. All it means is you try and collect more tax and you don't spend more than you earn. There is an alternative called Iceland. They placed their institutions in receivership. They restructured. The currency lost 60%. All right, so our New Zealand dollar falls 60%. Inflation shoots up and the GDP falls by 7%. Nationwide protests, the PM resigns. Now, a few years on, yes, we might be going to get 3% growth and it may be sustainable. We'll wait and see. So cold turkey worked, but at a massive cost. So it is a question of be careful what you wish for. Right, last topic. Ethical investing and the industry response. The funds management industry has responded to this by adopting a few processes which we'll summarise as follows. Negative screening, this is where one endeavours to avoid direct exposure to bad things. The problem is what you and I might think is bad may be two different things. Engagement, you try to convert sinners to saints. In other words, you try and change corporates' behaviours or management's behaviour. It's an advisory sort of thing only, so therefore it may only represent a cost to you. And positive screening, where you rank companies according to lots of ethical criteria and reward your investment dollar accordingly. There are lots of issues associated with that, which I won't go into, but they are very significant. So basically there's no common methodology in the industry. What's the Anglican Church Pension Board's response? The board has legal and fiduciary duties as trustee of the church's funds, and in keeping with its Christian values has formally committed to ethically investing those funds, subject to there being no conflict with its legal and fiduciary duties and that we can do it in a practical and cost-effective manner. What does that mean? It means that we endeavour to avoid exposure to tobacco, gaming, armaments, breweries and pornography, where the activities of key executives raise serious ethical concerns and where there's been a poor track record on the environmental and industrial relations side, and where management is excessively concerned with how well it pays itself. The nice thing is there is no conflict with the investment objectives, which are mainstream. So our investment results can be benchmarked to anyone around the country. And the board makes no allowances for those ethical factors when it evaluates how I or Garry does their job. Engagement. We do, or the board does, formally communicate with companies on relevant issues, and we vote our shares, as should you if you are a shareholder in any company. Again, no conflict with investment objectives, and for positive screening is not formalised in our process because we think there are conflicts with investment objectives and other significant issues. So, finally, what's the impact? We think a likely immaterial impact on our normalised returns relative to benchmark. It may help avoid negative shocks to the portfolio. That certainly outweighs any cost, incremental cost involved, and it is a small cost to the board. And it certainly enables the board to act in a manner consistent with its own beliefs and views of its members and clients. Thank you very much.
Thank you, Simon. So, thank you very much. So, Simon has told us that ethical investment involves an immaterial impact on normalised returns. I think that means it doesn't make any difference, basically, Simon. Is that right? We'll come back to that. But I think those were your words, an immaterial impact on normalised returns. Correct. Okay, all right. Well, this is one of the areas that's really interesting to talk about later on. But thank you very much for a very, very helpful introductory set of remarks covering some really difficult territory in a very clear way, Simon. So thank you very much. Garry, over to you now.
That's not my sleeping bag. That's my ammunition in case I need it later on. I'll tell you about it. Well, good evening, ladies and gentlemen, and Mr. Chairman. It's nice to be here to talk about a subject which we could talk about for about 3 weeks, and we'd all still be wondering about ethical investment. Yes, please, I do. Yes, I thought they'd be on next. Oh, sorry.
They just keep going. Yep.
Right. Now, following on from Simon, he's given you an overview, I think, or of the system, of what happens, and I'm going to give you the underview. And after following Simon, I feel like the man who lost his donkey. You know, he had a donkey in his backyard. He had quite a big backyard, but he woke up one morning and the donkey wasn't there. So he thought, well, I better find this donkey. So he wandered up and down the street, singing and whistling all the time, asking people if they'd seen his donkey. And one guy said, hey, you've lost your donkey, have you? He said, yes, I have. He said, well, the donkey's a valuable creature. Why are you whistling and why are you so happy? Oh, he said, I'm happy because I wasn't sitting on the donkey when it got lost. So I'm feeling a bit lost with some of Simon, because it really, what he said was something that we should be thinking about over a longer period than 20 minutes. Now, let me declare an interest. I'm a sceptic about the subject. I'm a sceptic. I'm a sceptic not because I don't think you have the right to decide where you put your money, and if you don't like something or think it's unethical, that you don't invest in it. That's fine. But the whole business has been institutionalised. And so therefore, ABC along the road, he runs a policy or a portfolio which is, we can call it what you like, and I'm going to give it a number of names, but it's ethically pure. And so you give him your money, and so his ethics count for your ethics, and all's well in the world. This all began a long time ago. The notes say that I've had 30 years' experience with the pension board on ethical investment. They put that in deliberately because if anything goes wrong, they can say, oh, that's Garry Gould's fault. He set up 30 years ago, you see. And they're going to engrave my tombstone when I die. They're going to put a note on about a disclaimer. They'll let them off the hook. Now, when it all began, we have been looking at this thing for a long time. And it all started around the early 1980s. And it started because of something that happened when we were leading up to the 1980, which resulted in the 1987 share crash. And our general manager of the day, we called her a general manager then, but she didn't like the word general. It sounds too common, so we now call her a CEO. But she was a general manager then, and she said, now, this raises some interesting questions. And that's what got us started. Later, we found that the Church of England was looking at exactly the same thing. And later on again was the Bishop of Oxford's case, which I'm going to refer to, which is a landmark decision on this very subject. And then by the time the wine box case came along, we were all cooking with gas on this subject. Now, Simon has referred to the fact that the pension board puts in its statement, it endeavours to. It endeavours to, because nothing in this world is perfect, folks, if you think it is not possible to have an absolutely ethically pure investment to meet everybody's criteria. Okay, now let's have a look at some of these overheads. It's morphed over a range of names: ethical investing, socially responsible investing, environmental, social and governance investing, morally responsible investing. I thought that's what it was, but it's not. It's mission-related investing. That one tripped me up completely. Environment, social and economic impact investing. Corporate social responsibility. When I saw CSR, I thought it related to the sugar company, but actually it wasn't. They're all the same things, but they have different emphases, actually. Okay. Now, as Simon's referred to this, but I just go over it again, the conflict arises over what is unethical and from what or whose perspective. And Simon referred to that. Application raises huge contradictions and issues. The general belief, if we wish to be ethical, we find a manager, hand her money, feel clean, pure, and sleep happily ever after. Well, you ought to have nightmares if that's the way you operate, because it's not possible to have one ethical portfolio covering all eventualities and all opinions. Hello, we've got a blank. Right. Now, I want to talk, actually, Simon's one should have been in there, that one that you put on. Go back, do I?
No, keep going. You just.
Oh, it's on the next one, is it?
You've got the first section. If you, yeah, that's it.
Okay. All right. Righto. Well, this is not quite the way I wanted it actually, but Simon referred to these things that we look at negative screening. Now, that's a broad brush coverage of the things we look at. And I'm going to deal with that top line almost exclusively, but I'm going to refer to these other things further down at the end, and then we'll have a fireside chat about a few things. Right. No, go back one. Let's talk about tobacco. Unethical. There is nothing unethical about smoking. You can smoke to your heart's content. If I see somebody sitting out in the rain with a cup of coffee smoking a cigarette, then that's fine to them. Now, I might think it's bad for health, but there are a lot of other things that are bad for you too. Excessive eating, driving instead of walking, oversleeping, technology, alcohol, gambling and sex. They can all, to some extent or other, be bad for you. And some of them we might say were unethical. But there's nothing unethical about smoking, but it may be bad for your health. So, we think, the pension board, that there is a problem with tobacco. And so, but you look at it, you say, well, is it the tobacco grower? Is it the manufacturer, the wholesaler or the retailer? Which one of those are you going to have a go at if you don't like tobacco? The investment trusts and index funds all hold tobacco shares. And tobacco has been quite a good investment over the last year or two. So, but we say no investment in tobacco growing or manufacturing. That's a decision we've made. And you may not agree with that, but that's what we've decided. Right, let's move on to the next one. Gaming. Gaming is a recreation activity for many. I don't know whether any of you ever buy a lotto ticket. Don't put your hand up if you do. I'm not going to ask you to do that. But some people do that. Some people like to go to the horse races and have a little go at the pokie machines. They can all become addictive. So the pension board says, okay, we don't think that being involved in gaming is a good idea. You may disagree with that. But that's the decision we made, and we don't have any investments in Sky City. Right. Armaments. Now, this is a very tricky one. The primary role of government since biblical times is defence of the realm. Now, that's going to stir you up, isn't it? Defence of the realm is a primary function of government. You can't have anything else if you don't have the realm defended. You don't have justice, you don't have anything. So, what is wrong with armaments? Are we concerned with the manufacturers of aero engines for both commercial and military operations? Do you fly in aeroplanes, anybody? Well, the manufacturer of the aeroplane and the aero engine are probably making them for military and civilian aircraft. Electrical companies produce radar systems and lighting for military and civilian airports. When you land at night, you need a radar system. That radar system may have been made by a manufacturer who manufactures them for military airports as well. The component manufacturer supplies parts for all of the above. The metal manufacturer supplies material for the components. The mining companies produce the raw materials or the input. So what do? We say we're out of armaments, so we don't invest in any of those? Really? Avoid them all and invest in government bonds. But hang on a minute, the government spends money on war, Afghanistan. The British government is spending billions on aircraft carriers right now. So what, do we not buy any British government bonds? Question. Breweries. Now, this is an interesting one too. When I first got into stockbroking, just over 50 years ago, my mentor said to me, now, Garry, I want to give you a little bit of advice. And he gave me 3 bits of advice, one of which is relevant tonight. He said, now look, if a woman ever comes in to talk about investments and asks you what you would recommend, don't ever recommend a brewery, because it might stir up something because there's a drinking problem at home. Now, if she wants to talk to you about breweries and asks you what you think about the breweries, you tell her what you think as an investment. But don't ever mention it first. Never forgotten it. That was 50 years ago, and it's relevant now, breweries. It's the original sort of, what shall I say, traditional drinking. And so we at the pension board don't invest in breweries because we just don't like them. But we're prepared to put our money in wine companies. Now, is that a contradiction? When you go to church, you're handed out communion wine. You probably go home and have a drink. If you don't ever want to have a drink, then don't invest in wine companies. And if nobody invests in wine companies, there'll be no drink, no alcohol around. That's fine if that's what you think. But we think it's hypocritical if they serve wine at communion, but we can't invest in wine companies. I'm not too sure. We've probably got one in our portfolio. But it does infiltrate through the investment trusts and so on. And Paul seems to think it's all right to have a little drink every now and then, so we put that down, and Jesus turned water into wine, so we thought that was probably okay too. Now, pornography is another one that probably there's not too much argument about. But you see, the problem is that the biggest users of the internet are sex and gambling. So what do you do then? You avoid technology stocks, Yahoo, Google, Facebook, Sky Network TV, and all other companies devoted to promoting news. Do we avoid the suppliers of componentry, of technology? You see, the whole thing trickles down into so many different areas. I want to get through this as quickly as I can. Okay, I come back to this one again. Now, I've talked about the first line. Incidentally, where the activities of key gaming executives, that word gaming should be on the top line. The executives are not carrying out gaming while they're doing their job. It's dropped down there. So I've talked about the top line, but I want to just touch quickly on these other things down here. Now, I want to just tell you that when you're running a fund or managing money for people, and you talk about ethical investment, you have to do some homework on it. Now, I just want to show you a few things here, because these reports, we have to go through them and ensure that what's in them is okay for our investment. And it's a pretty big job. This is the report of the Royal Dutch Shell Petroleum, and there are 177 pages in it, and the number of pages devoted to environment and society and ethical matters and directors' remuneration is from page 50 to page 90. And I have to read through all this, you see. And that's the Royal Dutch Shell Petroleum. Now let's take another one here. What's this one? British Land Company. Now the British Land Company is another one. There's the stuff that is relevant. Forget about the figures, forget about whether they're making money. This is all about anything else. We don't worry about things like that. No, we want to know whether they're ethically pure. And you see, the problem with the British Land Company is just this, that they own properties. And I'm not sure, I've been reading the British Land for about 5 or 6 years, I'm not sure whether one of their buildings might not have, in the bottom right-hand corner, a brothel. I'm not sure about it. I haven't been able to establish it because they don't tell me. So that's a risk we take on that sort of thing. Now, I'll just dig out one, and I've got them here. This is a good one. This is Glaxo. Now, this is a beauty. This is 248 pages, this one. And what I'm talking about, all the stuff I'm talking about is from page 80 to page 134. Glaxo, incidentally, started in Palmerston North, and it's now the 4th largest company in the UK. And, I mean, it would be nice if it's still here. And it's probably the 2nd largest pharmaceutical company in the world. But you see, this is the problem. You've got to go through all this stuff and see what it says. Now, I picked up one here, and I just want to touch on this one because this was an American one, and they're really interesting. And by the way, the pension board has its biggest investments in America. We have the biggest equity portfolios in America. Why? Because the US is 55% of everything that happens in the world in the equity markets. You can't afford not to be there. So we have. Now this one is. I'll just dig it out here. It's Minnesota Mining, and this one is a smaller one, but it still has about 100 pages there. But then they send you another 100 pages on the remuneration thing as well, with notice of meeting. Now this company, I want to tell you, is a bellwether of the American economy. There's not one person here who hasn't got stuff in their house from 3M. From Scotch tape, to discs for computers, to fasteners of clothing, everything, they make everything. And it's just interesting what they say, because I'm just going to tell you that on page something or other it says, 1 minute, all right, 1 minute, okay. It says here, under the electro and communications business, that it provides certain stuff, as well as aerospace, military, automotive and medical markets. And then it goes on to talk further on about its results, and it talks about safety, security and production systems, and it talks about systems for the military. And then you go on further on and there's another reference to the same thing. So they're making stuff because, you know, the funny thing is the military are one of the biggest users of computer stuff now, computer hardware. They use it for their missile systems and all that sort of thing. And when their planes break down, they buy Scotch tape and stitch them up again. So this company, now is that an ethical investment? Right, I just want to give you one more thing because this was quite interesting. I could go on, there's a lot of stuff I'd like to say. But I want to tell you just quickly that some years ago I had a visit from an order of nuns. And they came along with their solicitor, and they sat down and they said, now, Mr. Gould, we'd like to make some investments. And I said, yes, certainly. The head sister was the one who spoke. The others didn't say a word. And she said, now, I just want you to know there's some things we don't like investing in. I said, of course there are, sister. You can say whatever you like. She said, we're not too sure about smoking. We just don't think we should be. I said, that's absolutely fine. You're entitled to do that. And then she said, well, you know, and we're just not too happy about armaments. She said, we just don't think making guns and things is a good idea. So we will keep away from it, she said. And I said, oh, that's fun. And I said, probably don't want to invest in alcohol. Oh, no, she said, we like our little drink at 5 o'clock at night. I had another client who said, when Woolworths turnover in alcohol gets to 12%, we don't want to own the shares. Because 11% was okay, but 12% was too much. So when they got to 12%, they sold the shares. Okay, I haven't got time to talk about the Bishop of Oxford's case, but the Bishop of Oxford, just to tell you what the result of that case was, it arose because the Church of England, the Bishop of Oxford, by the way, was a church commissioner. So he was taking himself to court along with all the other commissioners. And it was to do with their investments in South Africa at the time. That was a big issue. Investments that should not be directly or indirectly in groups of companies other than banks, which derive more than 10 million in annual profits for South Africa, or more than 3% of the worldwide profits from South Africa. The Commission's ethical policy excludes about 13% of listed UK companies. The companies in which the Commission's hold shares would be excluded under the suggested criteria would comprise a further 24% by value, and it would eliminate 65% of the oil sector, and the judge concluded that it was impossible for them to invest prudentially if they eliminated all the shares that the Bishop of Oxford said they would. And he said that is a matter to be pursued, if at all, elsewhere than in this court. Thank you very much.
Thank you, Garry. Well, I'm very pleased that it's all right to invest in breweries. And wine and wine companies. Well, all right. Well, maybe just the ones that produce red wine, maybe. All right. Thank you very much indeed, Garry. I think your presentation, amongst other things, highlights the real complexities of the whole business of trying to think about responsible investment, ethical investment, and so on, and that this is not a simple matter. And I think, Margaret, over to you now. You're going to highlight that further. So, please take the floor.
Actually, I feel somewhat breathless after following that discussion. My name is Margaret Galt. I am a member of the Church Property Trustees for the Presbyterian Church. Now, the Presbyterian Church Property Trustees have many responsibilities, including investing all the pools of money that are involved, that the church has collected over time. There's the Minister's Pension Fund, which is very similar to the Anglican Pension Board. There's a mini banky thing that we run for the parishes. There's collected up all the bequests that have been left, and so on. Now, the trustees have to do something with this money. In some ways, we face exactly the same dilemmas that any person faces when they're investing their money. And so I decided I'd take you through some of the thinking we had done about our investments and how it might relate to your investments. Because from my viewpoint, the only difference between me investing money and me acting on the trustees investing money is the number of zeros afterwards. I wish I had their number of zeros, but that's life, isn't it? Right. The Presbyterian Church, for any who do not know the history of the Presbyterian Church, which may be some of you, was started in Scotland. And we all know, let me just find my first slide, what the Scottish are like. So you would expect that the Presbyterian Church, right from the start, had a very well-developed theology about money and about investing. Well, actually, you'd be wrong. And when I ran my mind through it when I was preparing this, I thought, the Westminster Confession, the start of our church, our kind of background, foundation document, I can't think of anything about money in it. So I duly searched through my copy of the Westminster Confession, and there isn't. There's not even about giving to church. So what is this? If you read around the time, and in fact even the Westminster Confession, the Presbyterians started with, "You shall love the Lord your God with all your heart, with all your soul, with all your mind, with all your strength." And it stood to reason your pocketbook was in there as well. There were bigger things that they were thinking about. I wanted to put it in that context because it's a really important context to put investing into. I belong to this church here. On Sunday, when we take up the collection plate, as it's being walked down the aisle, we all stand. That goes back to that basic theological idea. We stand because we are indicating that we are not just giving to God that money, we're giving ourselves, all of ourselves as well. So from going back to the title of this talk, from a Presbyterian viewpoint, and I think from my compatriots would agree with this 100%, ethical investing actually can't be a contradiction in terms, because if we can't invest ethically, we can't invest. That's how it breaks. Our first loyalty is to God. So can we invest, is the question. That's the theory. The theory is fine. But as my previous speaker has said, the doing is hard. Okay? We have this parliament of the Presbyterian Church called the General Assembly. Meets every 2 years these days. Since World War II, this group has discussed principles of investing no fewer than a dozen times. Even our hot button items only usually get discussed 3 or 4 times. But money has been there 12 times. And it's because the doing is hard. Now, the last time we had something was in 1983, when we had a joint commission with the Methodist Church to decide what guidelines we should put out for our parishioners. And this is a quote from the beginning of their thing. This is not an attempt to give a full moral and theological argument. There's too much divergent opinion among our own committee members as to the meaning of the particular passages in the Bible. In other words, they couldn't even agree on what the passages in the Bible meant, let alone on what that meant for their investing. Having said that, I'm going to come back to their report because despite their start thing and despite all the things that have been said, and I agree with a great many of them, they have produced a report that has actually lasted. In the subsequent discussions, the 1983 statement on investing for parishioners has stood the test of time, and it's partly because it's very general. But if you'd like to see a copy, I have brought some with me. It's quite short, it's only 4 pages. In the early 2000s, the General Assembly asked the trustees to reflect upon and report to them on all these funds that had started up, your socially responsible funds, ethical investment funds, moral funds. We were getting many plugs that the trustees, when we were investing in the church's money, should only be using those funds. It actually turned into a really quite interesting little thing to think through. And I had the great privilege of actually being the chair of the little subcommittee that did the thinking, so hence my interest in this topic. And one of the things we actually came to was the point that has already been made. If you choose one of these funds, you are choosing not your values, but their values. So you need to first be sure that your values and their values lined up. I haven't looked, I have to confess, at the universe of socially responsible moral funds that are around there now. But at the time, we went back to General Assembly and said, while we're not averse to going into those funds, there are three things that rather worry us about them. The first was the emphasis on worthy. These funds kind of paraded the special things they did, whether it's, you know, a health kit or a low carbon dioxide emitting technology or something like that, versus the normal. And again, perhaps this goes back to something that is deeply ingrained in the Presbyterian tradition. In our tradition, we do not separate off Sunday as holy and the rest of the week as not. What you do on Sunday and what you do on Monday have to line up. We do not say that people who, like Alistair, are ministers, have a more sacred job than the job I have working in the Treasury. We all serve God where we are. The normal is part of God's existence. We called it the give us today our daily bread factor. If we really are going to pray, give us today our daily bread, we've got to be prepared to put our money into bakeries and into supermarkets and into the trucks that take the bread from the supermarket, the bakery to the supermarket. All those things are worthy investments. And a lot of these socially responsible investments were downplaying the value of investing in the normal. The Shakers have this, if you remember the beautiful Shaker chairs and things like that. Things in everyday life also are things we do for God. People versus other factors. A lot of the funds that were on the market then stressed other factors. A lot of them at that stage, because it was topical, stressed environmental factors, but it could be any other factors. For us, we felt that if the first commandment is to love the Lord your God with all your heart, soul, mind and sense, the second is to love your neighbour as yourself. And a lot of them were not in that space. And this goes back to, if it's going to invest, they have to look like your values. Finally, there was a bit of discomfort about the way some of these funds thought about the use of natural resources. In fact, and I've brought the position paper that we did, has a very intemperate for the Church Property Trustees, I'll comment on it, about this. The Bible, of course, has a nuanced thing about the earth. We are there, and I've quoted the bit out of Genesis, the Lord God placed man in the garden to cultivate it and to guard it. Both are important. Whereas the trustees, reflecting on what we found, said, we do not share the difficulties some have at any use of God's creation, e.g. some of the anti-mining funds we did, which in its extremes make humankind sound like vermin whose extinction cannot come soon enough. There's something again here about our values lining up. So, where did we end up? We ended up where the Anglicans ended up, or very close to it. We have our 5 no-nos, our negative screen. They are the 5 things that we think our church community have a reasonably strong negative reaction to. And I take all the points that have been made, that some of these are actually quite debatable when you get into it. One of the lovely ones that we don't have to debate is actually alcohol. The reason why we don't have to debate it is the Presbyterian Church debated it endlessly back in 1914, and our Act of Parliament actually says we're not allowed to invest in alcohol at all, so end of decision. Otherwise, I think that one might be one that we have more debates over. But actually, all of them, as we have seen, can be pushed further than you can push on them. But we do feel that we have general agreement on those. And everything else gets judged on its own merits. So, going back through that General Assembly guidance, basically, I think there were 4 points that they brought out. The first was the one they started with. The love of your Lord your God encompasses your resources, including your investments. That's where we start. You should be able, therefore, to justify your investment choices before God. Now, really hard, some of those, and there's a lot of debate about that. It suggested you monitor your investments, and this goes back to the voting on things and so on, both for their impact on others and on the environment. An SRI fund, a socially responsible investment fund, may be a way to do this, provided its criteria matches your Christian conscience. Can I give just a slight little thing about monitoring your investments and encouraging you to do so actively if you have them? Some years ago, I was involved in a company which had three or four unfortunate deaths among their workforce. This was probably 20 years ago. And unhappy. I was an unhappy investor. So in the end, I wrote to the chair of the board. I thought that was the right person, given I was a shareholder. And I expected that letter to go the way of all good letters, never to be seen again. To my utter surprise, about 6 weeks later, I got a letter from the chair of the board to say, your letter got tabled at the board meeting and was discussed. And it then went on to say that they were also concerned that they'd had these and they were taking these actions. It taught me a lesson. Even a small shareholder can make themselves heard. So don't think that your letters will disappear into the ether. Finally, the point that God blesses the ordinary as well as the extraordinary. So companies that are efficiently producing worthwhile products are also socially responsible investments. I have the two position papers. If anyone's interested, just take a copy. Thank you.
Thanks so much, Margaret. Thank you. Thank you, Margaret, and thank you in particular for adding a number of really quite important theological considerations into your presentation, but again highlighting some of the complexities that we're faced with in this environment, and also highlighting that small shareholders can speak and make themselves heard, and that there's probably a responsibility to do that on occasions. So, last but not least, we have Mark Richards. Mark, welcome to Wellington. Mark comes from Palmerston North, and we look forward to your perspective on this, Mark. I think we probably just move on another one there.
Thank you.
Just use the...
Well, good evening. Thank you for the invitation. When Jonathan rang me, I'm a moral theologian by training, so I don't come as an ethicist, and I don't come as an economist, and I don't come in as an investment manager. And I said to him, my specialty was in medical ethics. So I come as the neophyte being asked to face these issues, and I went off and did my reading, and I've heard everything that I've read. And I thought, well, where to start? And so I didn't really quite know. So where to start was a good question. I thought, doing a bit of exploration, that we're not the only group gathered to ponder these issues this evening. There was a group of business leaders have actually, from around the globe, had gathered last weekend at the Vatican for a conference which is called an Executive Summit on Ethics in the Business World. And in preparing that meeting, there's a phrase that they're using, and it hit a chord with me. It said, what happens if we look at things differently to how we are used to looking at them? So I've gone out on the ice a little bit on the water in actual fact, and my task this evening I've placed as trying to find an interface between the gospel and ethics, economics, and specifically investment. Now, in doing so, we had a number of choices. And in fact, the first two presentations tonight probably represent the first of these. We can start by discussing economics, its insights, investment policy, and its principles, and then ask, is there a place for the gospel or a Christian response? We'd start asking questions such as, is there a common language? Is there a common set of perspectives from which to start? Are we even able to discuss an interface between faith and investment? Or we could start somewhere else, and we could start by discussing ethics, and we could go to ethical and philosophical ethics and start asking on the interface between ethical evaluation and economic theory and investment policies. And then somewhere over there, someone will say, and faith. And people will say, oh, hang on, we'll leave that over to the side. We'll leave that maybe for the moral theologians and we'll ignore what they say. Or we can start in an entirely different place, and I do think it's a little bit going out on the water, and that's where I started to try and prepare for this evening. What would happen if I took the fundamental task of the Christian as my starting point and tried to look at things from an entirely different way of thinking? So, what's the fundamental task of the Christian? The fundamental task of the Christian is to evangelise. That means to find good news. To find good news in the place and time in which we are living. Where are we living? We're living in the second decade of the 21st century in a community which is dominated by issues of business, investment and financial security. Do we have any good news to find there, is my question. And I think that's the core of the task which for the next 10 minutes I want to face. In the midst of global financial collapses, free markets, attempts to legislate for unity, and proposals to maintain the euro and social supporting structures, what happens if we examine these issues and the ethics of finance and investment from a different perspective? And that is of an itinerant Jew of the first century who had the audacity to take seriously the perspective on humanity and society which he and his community had been formed in. Now, there are two key concepts which for the last 2,000 years have been pondered on in moral theology. They are, and they start here, we were created in the image of God. In the image of God, he created them, male and female, he created them. And the second was, whatever you do to the least of these, you do to me. Over 2,000 years, they got distilled, and they became, in the image of God, became the universal dignity of the person, universal human dignity and human rights. The second was, whatever you do to the least of these, you do to me, became the inclusion of all in the pursuit of the common good. They are two fundamental moral principles on which we have tried to evaluate our behaviours over the last 2,000 years. So do these core theological and moral theological themes or motifs, if taken seriously, do they make any difference to us? And start to ask questions of the policies of our investment boards, and etc. My first point will be to say they're not going to offer specific instructions. They're not going to offer specific policy or procedure. They're much more fundamental. They encapsulate and they express a milieu, a framework of values, a set of presuppositions or perspectives, an ethical perspective from which all other work proceeds. It's at the fundamental ethical level that the debate must begin, and which I don't think we go to. The core debate isn't how to invest. I think it's interesting that the core debate is in actual fact who's allowed to participate in the socio-economic game. So the principle of the dignity of the person finds expressions in elements such as the dignity of that person. And it starts talking about every person having a right to share in the core and basic elements of life in society: food, shelter, water, health, education, a stable environment to raise a family, educate children, and to partake and participate in the social and political structure. Oh yes, we say I agree with all those basic rights. But what happens is that we take that list and we ask the challenging question then of our investor. What happens in actual fact when we search the globe for the lowest wage? What happens when we search the globe for the greatest tax break? What happens when we search the globe for the place in which we don't have to contribute to educational welfare or the infrastructure of the community? What happens when we go to seek the lowest price for the raw material, don't really worry about the environmental impact, the least obligations or interference, or we set out free trade which enables us to export the product for the place of greatest profit and margin? What are the consequences of that on the universal right of dignity of the person? These core rights challenge the priorities of those who invest and seek to have the cheapest extractive industry or product impacting on the environment, the air, the water, but most importantly, on the inhabitants of the place who are compromised. Now, fundamentally, 65% of humanity is impacted in our investment decisions by that particular lack of equity. I know I'm going to have to keep running. And so I'm going to have to go, I'll jump a whole lot here. I want to then go straight to the common good. See, the core presumption is that the investor are able and should be able to maximise the return on the investment, and that there's a duty of care on the manager of the fund or enterprise to return such to the stakeholder. Therefore, is the duty an ethical imperative to take the low wage element, to produce at the lowest cost or with the least impediments of tax, labour law, unionised labour, environmental constraints. It's though the big question, what happens at the heart of that investment decision? That decision to take that easy option has been at the base of our society, and it was the base of why many Presbyterians are in New Zealand, because they were taken off their land, they were taken out of their crofts, they were taken as cheap labour, and the people taken into the agricultural workers right from the fundamentals in our structure to exploit labour, to exploit people's needs. So what of the common good? The fundamental question again is it the commonwealth of the investor, the commonwealth and good of those whose contribution is capital that is to be protected, or is it the commonwealth of those who offer in the process their labour, their time, their intellectual property, their skills, the commitment of their land, their harvest, the raw materials? There are fundamental principles which we probably have to ask at the core of that. So I've got another 2 pages I'm going to jump over, and I found a very interesting, I thought, summary of where are the ethical implications to be placed. The first is from a guy called Daniel Finn, who's Professor of Economics and Theology at Collegeville. He says there are 4 elements to be fulfilled for making a more moral economy and an ethical or moral investment. The first is the morality of the individual or the organisation. Every individual or organisation we know must actually tell us what the true state of the proposed investment is. They must tell the truth. The investor, in applying to invest, must have the funds to actually put there. There's something at the individual level. We need to know that the funds are honestly come by, the fruits not of crime, extortion or prostitution. Of course, we know now that that is now the most honourable profession. But we, as individuals or organisations, are not allowed to misrepresent the state of the prospectus. Secondly, is the legal structure of the market. The market cannot be allowed to be absolutely free and unregulated. It must have legal limits to prevent the worst abuses. A market cannot violate core elements, we believe, of environmental, social or cultural regulation. But how do we take that globally? How do we take that to, in actual fact, protect the individual's rights to their own place in the production scheme? Third, says Finn, is that the needs of all must be met. This is the fundamental challenge to Western capitalism. It is not just to us as white Anglo-Saxon investors. All must be able to be incorporated and to profit, to be partakers in the social enterprise. The poor have the right to food, shelter that is primary and overwhelms the private property rights of any investor and the wealthy. And the last is that there is a commonwealth, a good. Principles of distributive justice call for a vibrant civil society. We have to try and form structures in which we have cooperative or association or are able to be part of all aspects of society. And in these days of global investment, that is really hard. Because the fundamental question that 3,000 years ago was asked of my neighbour down the road, we are now asking of 6.5 billion neighbours. So, I want to finish here. The question which I want to put is the same question that was asked of the first person recorded as wanting to monopolise the land and the inheritance of life and to take all to himself. As he distanced himself from the other, he was asked by the source and font of life, "Where is your brother?" And he answered, and it says, many who have followed him as people of privilege, birth, wealth, racial or cultural right, they have said, am I my brother's keeper? And the same answer keeps on coming back to the investor and the person of privilege, to the nations of wealth and exploitation. What have you done? Listen to your sister's or brother's blood, their life crying out to me. 65% who are starving. And 1,000 years later, there was a preacher who was asked to respond to the question, who is my neighbour? Who is my brother or sister? And they answered, he said, what does the law say? And he said there was a person going down from Jerusalem to Jericho. Now you have a choice. It's an ethical choice, a moral choice. And it's contained in every single investment decision that you and I make, every political decision we make. Do you pass by on the other side? Or do you see the neighbour, the one who is different, the one who's in the dust? Do you lift him up, put him on the saddle, and call him or her your brother or sister, and look for our common wealth? Or do you pass on by, protected, preserved, and privileged? So my question tonight is to actually ask a different question. What's at the core of the system which we are living in, and what would we be asking of ourselves?
Thank you very much indeed, Mark. Thank you for broadening the horizons there, philosophically and theologically and practically as well. And if I could just make one editorial comment, the question, who is my neighbour? You mentioned 6.5 billion people. I think we're actually up to 7 billion, Mark. But in fact, one of the very, very important factors we need to bear in mind today is that our decisions will have consequences for billions and billions of people who are yet unborn. And so when we think about who is my neighbour, we need to think about that not just in spatial terms now, but in temporal terms over generations, potentially millennia. So the gravity of that comment is all the more heightened in the midst of the enormous technological capacity we have now. We've had 4 wonderful presentations, some theological depth and digs, and some humour and some sort of light entertainment about some really important issues. Let's just take 30 seconds to a minute just to stretch, particularly for those who need to perhaps move your back and make it comfortable, and then we'll resume for a period of questions and discussion. All right, how's that? Margaret? All right, good, excellent. That's the stretch. I did say 30 seconds. No slouching. All right. Well, first of all, I'd just like to ask the panel whether any of them would like to comment on anything that's been said by any of the other members of the panel, just to start with. You don't have to. And if not, then I have one question before we get underway, and then I'll open up the floor. And my question would be this, and it goes back, Mark, in fact, to your final remarks about being a good neighbour. Is it possible to be a competitive neighbour? Is it possible, in other words, to run your business in a way that does wonderful things for your business, but puts other businesses out of businesses? Because that's what business is involved in doing. By being better than someone else, you are going to be having negative impacts on those who are not doing so well. So, Apple computers, Apple is doing extremely well at the moment. Nokia, much less well. And if we didn't have a competitive system, of course, we'd have a very different environment altogether. But, can one be a loving, competitive neighbour? So any quick thoughts about that? Because that really goes to the heart of the gospel as it relates to business and investment.
Sorry, go first. Well, I said it was the other, in preparing this, there were so many ways to go. And the other half, which I have, is here is your talent. Oh, I went and hid it in the ground. Oh, no, there are 5 talents and there are 50 and there are 100. Or here is the gift. The gift is given for the service of, for the... Now, they are not to compete. They are questions which, in actual fact, are about... they are fundamentally cooperative, fundamentally co-responsible options. But you cannot bring your talent to the fore or develop it without it being within the community. And I think the fundamental issue which we have is the relationship between the individual and the community. I think communities as a whole can actually bring some degree of, within that competitive element, they can bring the richness of the individual to the fore without it necessarily being at the detriment of the other. Now, it's going to ask a different ethic in terms of your society and your social and community structuring. So I think, no, I don't have an answer. I think the angle in there is really needs to be explored.
But potentially a tension. Margaret.
Yes.
I was going to come at it. I'm an economist by training, as Jonathan knows, so I was going to come at it with an economist hat. I think you have to think about not just the immediate impact, but the longer term impact. What does competition give us? Competition has given us an incentive for companies to improve. You mentioned Apple has better computers, so it puts other computer companies out of business. Who benefits from that? It's actually the consumer. And by the improvements that have come out of the competitive thing, we have all raised our standard of living. And we haven't only raised our standard of living, even in the third world, the standard of living now is immensely much higher than it was a century ago. So if you're just going to say, is competition evil? We have to say, well, obviously I'm not talking about unfair competition where people are doing dishonest and things like that, but fair competition has a good side as well as the immediate negative. And that's the perspective I was going to bring on.
So we have creative destruction, in which there is the creativity and the use of the gifts that we have, but also there is the destruction as part of that. Simon or Garry, did you want to comment? Or
I think that may be overcomplicating it and rendering discussions something between a gamble, the way things operate as a gamble, versus, can there be winners, just winners? The problem with this sort of discussion is what the inference is that there must be a loser as well as a winner. Economics 101 says that if I make a widget and I sell it to you, there in theory is 2 winners. There does not need to be a loser. There may be a consequence, a negative consequence of that transaction making it not fair, but there is a redistribution model which takes account of that and makes that and helps make that so that there is still not a loser in that passage. What makes life difficult, and the law's come up a couple of times, is that it's not easy to have a relationship with production for profit's sake when we are removed as a shareholder from that production, right? Because via limited liability and via a corporate being an entity in its own right, it is required by law to be a profit maximiser, which one could argue is unjust and unloving, I suppose. I'm not a really expert on this sort of thing, but that is an issue which is not easy to reconcile, but certainly the way we would think of investing is that we are, Garry and I would regard ourselves as being investors in production, and we have an active view of that, and we exercise that by voting and by what companies do and so on and so forth. I think we get into problems when we start, there's a mantra for the ethical industry which says doing well by doing good. And you get into this problem of what is teaching finance or you're going into business, it is assumed that you want to make a profit. And there's nothing wrong with making a profit, as long as that surplus is shared or, not hoarded and all the things that come from that. The assumption, if you make the assumption that everyone is ethical to start with, then it's simply a question of degree and how that gets reflected in what you do. And if you were to ask what is the pension board doing, that's all the pension board is doing. It's saying it has a bunch of views, which it will express. That's restricted by the law in terms of how far it can go, but that's not an issue. That's not a problem. Some things we will do as a result of our beliefs, but overall, we are starting from the point of view that we're ethical, and it's a question of how far we take that when we make our investments. When you view it like that, that's not so complicated.
All right, Simon. Garry?
Well, by the way, Economics 101 reminded it was guns and butter, which is an unfortunate thing to be
Well, you see,
ethical investment.
yes, well,
I made the guns and you made the butter, so...
Yes, well, I think your 101, you see, probably covered both the win-win and the trade-offs, and I was really talking about the trade-offs.
Well, let's just think about it, because for many years New Zealand had a closed economy. And I sat through a church assembly in 1970, and the big argument was, what about our neighbour? We should be giving more money away in terms of aid. We should be giving 1% of the GDP away in aid. This was the big debate. And that was in the 1970s when we had a closed economy. Now, globalisation has changed all that. And we've done better than giving away 1% of our economy. We've closed down all our manufacturing industries, and we've transferred the whole lot to other countries. We've put thousands of people out of work, but the consumer loves it. Because when you go into a shop, you want to buy the cheapest T-shirt. You want to buy the cheapest can of beans. You want to buy a budget. You want to buy pans. You want to buy all these things that are half price. And they're bottled in New Zealand from imported materials which come from Thailand or somewhere. Now, so we're doing very well. I think we're thinking about our brother extremely well. But globalisation is changing everything the way we do and the way we do it now. And it's going to take a long, long time to settle down. And I don't know what the outcome is going to be. But it seems to me that unless everybody's got a university degree, it's going to be trouble getting work. Because there aren't going to be the manual jobs around. And so we've got a huge problem now, if you look at the ethics from a theoretical point of view in dealing with this sort of problem.
All right. Well, look, thank you, Garry. There's obviously a wide range of issues that you've just touched on, which includes the impact of globalisation, trade, etc., which probably go a little bit beyond maybe what we want to focus on precisely here, but they are all part of the mix. So, look, the floor's open. Who would like to make a comment or raise a question?
Which was, can I love my neighbour while competing with him and starting to put him out of business? I don't believe that competition has to be mutually destructive. Competition is a healthy spur. I'm sure that Microsoft is working better and harder and thinking more because of Steve Jobs' influence. In the various industries I've worked in the last 40 or 50 years, there's been a lot of competition. And in the profession I'm in, a lot of my esteemed colleagues would pinch a client from me at a moment's notice, but that was how it worked. We would have been much more complacent if I hadn't.
Yes. Well, look, all I'm doing is posing the question. You can disagree with the presupposition underpinning the question and the question. That's fine, but I was just raising it.
Pick you up
yes.
Because you used the word creative destruction, and I have to disagree with the comment made. I think that the creative destruction is huge. I mean, let's take Walmart. Walmart is the most powerful retailer in the world. It has the biggest labour force, I think, of any company in the world. You don't argue with Walmart. You supply at what they say the price is going to be. There's no argument, the phone will be put down. Everybody wants to get into Walmart to sell their goods. Every customer wants to get them to buy them because they're cheap. And Walmart has caused more businesses to go broke than probably any other business on the entire globe. So there is creative destruction around in many areas. So I think, and you can say that's healthy. Well, I won't argue with that point. It may be healthy in the long run, but my word, in the short run, it's not too well. Is what?
Destroying competitors or suppliers?
Both. Yeah, both. Yeah, both.
Yes. And And Walmart, of course, was founded by a Christian family. And I, you know, it again probably goes back to my question about, you know, what does it mean to love our neighbour, to be our brother's keeper? You know, presumably, you know, Walmart isn't going around picking up the mess that they create while doing obviously a very good job themselves in terms of what they retail. But
I just want to pick up that thing about mess, though.
yes.
I think some of these things are messy, but if you stop the mess, you stop the creativity. If you want to think about another one, and I'll pick one from way back when, so it's not controversial, hopefully, the coming of the motor car. Just think how many settlers are put out of business. Now, do we all want to give up our motor cars? If we go back to have horses?
Sure.
There's something here about, yes, it can be painful, but actually the reason why everyone does it is because overall there's a positive.
No, absolutely, Margaret. I understand the point, but it does still raise questions here about what it means to love our neighbour and so on. Yes.
Yeah, well, I'd say the same point as you. Are corporates now getting to the point where they're getting so large that they go beyond geographic laws and common sense and stuff like that and become a power in themselves, that they start to manipulate the economy, they manipulate, you know, social good around the world, and effectively they're influenced now because they are so large that they become a force and a law to themselves, and that ultimately is destructive. There's nothing wrong with smaller companies within a confined space competing and the process of evolution and elimination going on. But now you've got these mega corporates who are actually just taking over from governments and bypassing all the common law practices that the governments have set up to protect.
And our food supply.
And actually just sort of basically dictating terms to them through lobbying, through actually doing cross-border transactions and doing all things like that, which effectively negate what government was set up and us as citizens to actually try and put some caveats over.
That's kind of that.
Simon, please.
That was technically correct. Okay, and if we go back to the original model, it was we will get, there's nothing ungodly about production, right? In capitalism, it's efficient, it's liberating, and the better you get at it, the more opportunity you have to do God's work or whatever. So there's nothing wrong with that in that sense, and the state fits in by providing a justice element to that. The problem, you're technically right about the corporate, because the corporation now, as an individual, as I said before, is now technically a person. And indeed, if you look in the United States, I think, going back a long way here, so I may have it wrong, I think it was Ford versus Dodge or something like that, where the corporation's role was put under the microscope. And the question was, what did it exist to make reasonable profits, or did it exist to maximise profits for its owners? And of course the answer was, judgment was, it was there to maximise profits. In other words, it was there to hoard, it was there to really maximise its own wealth for its own purpose, which is unclear and not necessarily for the good of anyone other than itself. And then you go, well, who's responsible for that? And you're right, there's a problem. It can't be the workers there because they get paid a fixed amount, so they're just a hire. So it ain't them. Is it the shareholder? Well, it isn't the shareholder either, because the shareholder has been removed one step through limited liability. So therefore there is not a direct relationship with that activity anymore. So technically speaking, you have an animal that is answerable to no one.
It's a runaway train.
It's a runaway train.
Yeah, they also don't die, they last forever.
Yeah.
Yes, that's right. So it has a life of its own and is technically unanswerable to anyone.
Well, with that rather grim view of the state of modern corporates, comment?
Last comment is simple nonsense.
Do you want to?
You refer to the United States. I'm not sure which United States you're referring to. The one I know, corporates have evolved in a huge sense of social engagement, involvement, and most in particular, one of their highest costs is employee turnover. So I mean, their sensitivity to their own workforce, to
tends to be quite high. And in so doing, providing a community good and a community stability, corporates, their first and best assets are their own employees. And caring for those employees is critically important.
Yeah,
There are rebalancing. Technologies have obviously changed, and globalization of many markets. If we go to Detroit and look at the auto industry, the steel industry, we've been ravaged. And there's been huge anguish in large parts of the community. But that's not to say that that same rebalancing hasn't brought huge growth in service industries and other facets of the economy that have hugely elevated prosperity and well-being for a much wider range of people. Walmart has hugely increased people's capacity to get goods at reasonable prices. Maybe some people would say that they're too low. We ought to be paying Taiwanese garment workers more. The point is that they've hugely elevated the ability to access huge ranges of goods and services in ways and at rates that wouldn't otherwise be available. Consumers, that's us. That's the people. That's the general populace. Those are the people who benefit.
But I think,
Simon,
yes.
I was answering the question from a technical point of view, that is the corporate a animal which is a law unto itself in theory? And the answer to that is yes, it is. Okay?
But I don't share that view.
Well, technically speaking it is. It must be from the structure of it. Now that doesn't mean to say that we are then saying all corporates are evil and don't do good things. And that's the tendency of a lot of the argument these days with the sort of stuff that's going on. That is patently not true, because the vast majority of corporates exist to provide services and goods and are staffed by people who just want to do a good job, earn a wage, pay down the mortgage, and provide for their kids and make a reasonable profit, or allowable profit. So that is the reality of it. But I was responding to the technical issue that technically they are a law to themselves.
Well, I don't share that.
Well, all right. I think.
Well, he's ignoring an extraordinarily strong judiciary.
All right.
You say a law to themselves. What law are you referring to?
Well, I think we've probably exchanged views on this one, and perhaps we should move on. But I think the fundamental point, which I think people are agreeing on, is that we've got a situation where there's a two-edged sword here. Companies like Walmart do a great deal of good, as you say. They provide wonderful services for people at lower cost and so on. On the other hand, they also pose certain risks, and moreover, by virtue of their success, of course, they displace other producers and providers. But so we have this creative destruction going on. Now, since the session is really about ethical investment, I realise what we've been talking about is relevant to that, but it maybe people might want to come back to some of the more, if you like, heartland issues that were raised earlier about the sorts of things we should invest in and that we shouldn't invest in, and what principles should govern those sorts of decisions, and some of the complexities around that. But I'm open to where people want this conversation to go. Dave.
My byline, which has always been my principle, is I think, and you mentioned to it, which is once investment is not a transaction, it's a responsibility to engage with whatever the investee that you've done. And it's not about doing your homework and thinking, right, I'll put my money with these guys and I'm happy and I sort of walk away and go to have my dinner and go from there. It's a responsibility to ensure that you are tracking them, to making sure that they're doing and staying within the guidelines that you feel that you would like them to, and being vocal about it where you think there's areas where there's not sure about it, and being brave enough to sort of say, well, if it falls outside what I think it is, then and they're unwilling to sort of go, no, that's fine, but it's also my turn to sort of take my investment out of that. And so, irrespective of all the boundaries of what might be considered ethical or not, I think the process is that it's a responsibility to be engaged and continue to be engaged, and it's not just a transactional aspect of it.
Could I just, though, build a question on that, Dave, because I understand what you're saying, but for the average person who may have a small amount of money to invest, they don't have time to monitor all the companies that they may have a small stake in. That's really, not possible. So you're involved there in some sort of, trust relationship. You're hoping that the people who are making decisions on your behalf are making wise decisions and are doing some of that monitoring for you. I mean, it may be there are people in this room that have, the luxury of all the time in the world to investigate all the companies that they may have some involvement with, but most of us probably don't. So that's a challenge, surely, isn't it? And
I mean, surely, so it's not, if you're parking that responsibility to somebody else, your responsibility is to monitor those people to make sure that they're doing what you thought that they would be doing.
Yes.
So, I mean, it doesn't avoid the issue, just if you want to consolidate it into a fund manager, make sure you pick a fund manager, make sure you monitor the fund manager, and actually sort of get some accountability from the fund manager that fits within your ethics.
I thought I saw a hand over here before. Is that right? Yes.
The question you just asked, which is
Right.
for many of us, we're not really that interested in money, and don't like to keep track of it all that well. Don't feel I have time, and I'm certainly not going to make it a priority.
Yes.
So it is a frustration because I'm hearing what Margaret says about, there is that responsibility. You should know where your money is, but a lot of us do want to hand it to somebody else.
I think your response is right. That if you don't have the time to monitor it, then pick somebody who you trust, as you would with your investments. Probably a lot of people in this room have a kiwi saver, and because that's one. You want to pick somebody who you trust to put that money with. So, yes, that saves you all the problem of monitoring the hundreds. But you still do need to keep a little eye on that kiwi saver person, even if it's just once a year pulling out when they send you the blurb and just flicking through and saying, is this still looking like what I intended to invest in?
I think it goes one step further. Again, I'm sorry, I'm going to use my script. Sorry, some of us are prophets, and some of us are apostles, and some of us are teachers, and some of us are investors, and some of us actually understand, and some of us can read the accounts, and some of us can't. And in our family, mother's money is invested by the brother-in-law because the brother-in-law knows what this is about. My brother I wouldn't trust with mother's money because he doesn't have a clue about it. But if we wanted to sail from here to New Lear, he's a wonderful navigator. It's actually, and that's why I think these elements must be put wider in the communal aspect. I was reflecting, I've forgotten the guy's name, I apologise, but one enormous study out of Harvard, and it's just called the loyalty effect. So it was a big, it came out about 10, 12 years ago, and they just found that this element of trust, loyalty of your shareholder, loyalty of your staff, loyalty of your customer, was in actual fact directly related to the profitability and the long-term viability of your company. Now, that sort of framework has got another element underneath there, which is placing my monies or my account with somebody who can actually use it properly. Now, therefore I go the next question out, which is still, in what framework are they going to do that? Because I have other brothers and sisters who are also needing to be protected in those relationships.
Could I make a comment?
Yes.
Trust gets you to the table, but that does not remove the need for you as the investor to keep a very close eye on what's going on.
And a lot of people are taken to the cleaners by family members.
Yeah.
So you cannot just
You do need to keep an eye on
hand
it,
it
even
over
if it's
to
just
someone.
periodically.
I have a question. We're property people, as most of the church know. It intrigues me that property is it's discounted here, whereas I think ethically you're actually providing accommodation. People need accommodation. Why is it always just wiped off?
Well, I don't think anybody has wiped it off.
Well, it's discounted. You discounted it completely right at the beginning. Yes.
No. I think Simon was
You
simply.
said it was a bad investment. What intrigues me is why.
Well, Simon, do you want to clarify? Because you
Why do you think that investing in property is a bad investment? That's my question.
Right. Am I allowed to respond to this?
Yes. Briefly.
Well, you've got to be careful these days. The point was not to say, I didn't want to get into, is it a good or bad investment? The purpose of putting the charts up was to say, this charts would suggest that it is not a good investment in New Zealand. Right, you could make the case that it is not a good investment. So I'm not going to sit here and say it's a bad investment. Property could get a mention. There's nothing against or for property. It's just the conversation always with investing tends to go to debt and equity. Right, property is a form of debt and equity. It's a combination of the two. So it wasn't intentionally excluded. It was brought into my presentation because that's our part of the GFC. That's New Zealand's contribution to the GFC by the way we have priced property and what we did with the finance companies. I don't want to go much further than that, but that was one and the same. All right? And then I said, okay, if that's been in our experience, I've noticed that it's come back into vogue, certainly in the media. What do we think about that? But there's nothing wrong with property. Property is in our balanced funds as an asset class, along with debt and equity. So there was no intention to exclude it, and it has a role.
Good. Thanks, Bradley.
Yes.
Can
Certainly has a role.
I
Right.
just make
Margaret.
a slightly different but related comment? Among other things, the Presbyterian Church Property Trustees actually own all the Presbyterian buildings north of the Waitaki River. Long story about why north of the Waitaki River. So we own this building. So we have a lot of property. So, there is a role, big role for us with property. But we also own two farms, who two charming people left to the church on condition that we're not allowed to sell them. So we have to be farmers as well. Anyway, I think the ethical issues in terms of owning property and owning farms are actually the same ethical issues that you have owning shares and debt. Is this being used to do a service that is worthwhile? Is there, dishonesty and things like that going on? How do we make the choices between, with our dairy farm at the moment, we own to big time effluent disposal. I know more about effluent disposal than I actually ever wanted to know. How do we trade off the environment and the need to put in disposal with the fact that the money from that farm actually gets spent on children's work? And they're the same issues. They're not different issues, they're the same issues. And I just wanted to say that it's not a separate thing at all.
Right, yes, you had a question, and then David.
At least originally it was about investment. And the question still up on the screen is who is my neighbour? And I wonder whether we have put all the responsibility on the investment managers or the investors, because we have other roles. We are also citizens. We can campaign for regulatory reform, talking about the limits of the law. If that is the case, then the next job is to set the limits of the law or to reset them. We are also consumers. And in my house, there's an activism about fair trade and not using or not knowingly using products from sweated labour. If we assume our Christian responsibilities in those roles also, we don't have to do a whole lot as an investment manager.
That was a question I wanted to raise further down the table, and it was the question of the role of the investment manager. I worked in a corporate, and I'll just place this as it wasn't as an investor, but I was fascinated that there were whole companies who could only work with our company because we were US stock exchange listed. So there were a whole lot of US stock exchange listed companies who could only work with us in our particular, could only work with certain accounting firms, could only work with certain legal counsellors, and probably even their advertising agencies had to be linked. Now at that level, we were all taking a very healthy cut at profit line, which we weren't allowed to undercut. We weren't allowed, we had to set fees. So we had lawyers, accountants, investment managers, people doing other services who were all actually taking something along the lines of 10 times the average wage in New Zealand because we had access legally and those companies could only work with us legally. So I'm sitting there wondering about my investment managers, about who they're linked to, about what's structurally enabling them, and how does that relate back to their ethical responsibilities and how much they should take, how much they should take out of the transaction.
Good question.
Did you want to comment on it, Garry?
No, Simon.
Well, all right. Well, I mean, it's a very good set of questions. Of course, there are some laws around that and rules around it. But David, you have a question, so.
I want to thank the panel for giving us some very sophisticated and very interesting views. It's complex stuff. One of the things I take from it is that business generally is a very good thing. It's part of God's world and it's doing lots of good things for lots of people. Of course, there's some restraints on it. We've got restraints around fraud. Society puts some rules around it. But what we saw from some of those pictures that were painted for us is that there are far-reaching effects. And I want to make a particular suggestion for when people are engaged in these debates. It's worth going beyond the first few surface effects. We've heard, for example, comments on free trade. Free trade in the Economics 101 that we heard about before is actually a very good thing. It raises living standards very broadly, and you can actually redistribute wealth around the edges of that with the structures of society to provide compensation for some of the people who've lost out. We also heard references to foreign aid. Great thing back in the 1970s, where you had a target of 1%. I went to some economics classes a little after that date, where the Marxist lecturer argued heavily against foreign aid. Why was that? It was because it was putting small businesses out of business in the third world. Minimum wages in New Zealand might be another example. The minimum wage sounds like a great thing. Let's take people out of poverty. There's some clear evidence around that it actually throws some of the marginalised people out of work in the process. Now, I don't want to get particularly into any of those examples other than to say, I think what the sort of sophistication we've had from the panel argues for is that we get seriously into understanding the effects that we're dealing with. If we want to participate in these kinds of debates, there's research out there, there's material you can go on, and that's what we should be bringing to our thinking about ethical debates, whether they relate to investment or business more generally. So happy to hear some reactions to the broad principle.
Thank you, David. Your comments, Simon?
I'll set up something for you to think about, right? How many people here own an iPod or an iPad or iPhone? Okay, it's the majority, right. So you will no doubt have seen in the newspaper in the last 6 months of the suicides in the Chinese factories where these products are assembled. Okay? Now, how does one feel about that? Right? Now, the result of all of that and the publicity around the world, now Steve Jobs decided that that was not something that he would concern himself about because he effectively took the view, let's just say he took the view that I was acting in the law, a little bit like Nestle case. I'm acting in the law, so it's okay. Sorry?
Speak up, Simon. Yes, please.
So that view was, I'm acting within the law, that's the way it works, okay? He goes, someone else comes along, and the media interest in this rises. Okay, so Apple, then the new guy, what's his name?
Don't worry, keep going.
Decides that they will do something about it, okay, as part of, for whatever motivation, okay? Maybe to stamp his own sides were over the working conditions and payment that these workers were receiving. Okay? Now, the result of that is that the wages for those workers have gone up and the conditions have improved. Now, you can say that's a win, but let's think about it. It's not as simple as that. Strictly speaking, the gross margin on the iPhone has gone down. So all things being equal, the share price should fall. So for the dad who's got his education fund for his child in the United States and whose biggest shareholding by far is Apple, there is now a loss of wealth in that holding. Okay? The other result is that, let's pretend there's somebody from Apple who's been looking after production in China for the last 2 years and getting on a plane and going to China to make sure everything's all right, and is really, really sick and tired of doing that. And as a result of all the publicity associated with these sort of cases, some higher up people have to come up and kind of go to China and see what's going on, and they get sick of it as well, going to China every month to sort all this out. So the conversation goes something along, you can imagine this goes something along the lines, wait a minute, we're not making as much money out of this as we used to. What if we were to rerun the numbers on taking that production away from China and moving it back to the United States? Because guess what, I'm sick and tired of getting on this plane, and the numbers might actually add up. Now the net result of that is that you have, and there has been, a loss of demand for workers in China, and some production moved elsewhere. Now the question then is, who needed the job more? It's not simple.
Can I just add a little to that? I think often in these situations the losses are very apparent, the winners are not.
Yes.
And so the balance looks wrong, but yeah.
Well, I think amongst other things, it highlights, as David was mentioning before, I mean, the complexity of many of these issues and the fact that we're involved in making trade-offs and that there are difficult ethical choices to be made in certain circumstances, and that we shouldn't pretend that it's otherwise. Our actions have consequences, and some of those are positive and some of those are negative. And the question of who is my neighbour, while fundamentally important issue to address, doesn't necessarily have a very simple answer. There may be a variety of dimensions to it that generate genuine difficulty in deciding what to do. I'm conscious that time is almost up. We said we'd finish at 9, and we're almost there. So I would just like to give an opportunity to anyone who hasn't had a chance to say something or to raise a point to do so before we finish. No, all right. Otherwise, just to give the opportunity for anyone on the panel to make any final comment.
Well, I'd like to comment on that lady over there who said she hasn't got time to look at her investments or doesn't understand money or doesn't want to know about it. I think the sad thing for me is that there's a lack in the education system. The lack of ability for money management is absolutely amazing. It's a fundamental thing that we do every day, managing money. And I mean, I'm not criticising what you've said. I'm simply saying that it shows a lack in the education system, that we're not taught in schools how to manage money. And the reason we're not taught in schools is because the teachers don't know anything about it. You can't teach something you don't know anything about. And the point is that we teach a lot of other things in school, and so the apparent lack of ability to manage money has become so apparent and so profound in recent times that everybody's blaming everybody else for their own misfortune over the loss of money, and it's rather sad. Now, I just want to say one more thing about this, and that is, I haven't got time to manage my share portfolio, don't understand it. Look, if I own a property, do I never go to the property to see what's going on? Don't I go around to collect the rent? Don't I go and see if the phone's working, if the electricity's on, if the property's being maintained? I spend hours and hours going to a house to look after it, to make sure it's properly managed. What's the difference? Why is it that we can manage a house presumably to spend the time, but we haven't got that equivalent of time managing a share portfolio.
Yes, except Gary, if I could very quickly comment as an editorial comment here, New Zealand has a large number of small property owners, people who own one or two properties which they rent. Many of those properties are in extraordinarily bad condition, poorly maintained, and the part of the problem we have is that those properties that have been bought primarily for capital gain rather than for, to be honest, the provision of a service. They've been purchased largely as a superannuation, source of superannuation income, and we have a very, very poorly sort of regulated private rental market, which means we have a large number of, often low-income people living in very poor accommodation, which is poorly heated, poorly maintained, a lot of dampness, which generates all sorts of ill health problems, etc., etc. So nothing against property, please don't take those remarks, but the work I've been doing on child poverty just highlights to me some of the really difficult issues we have here, and it's partly because people are not taking their investment seriously in terms of the sort of maintenance and
so
management of it.
It's a lack of money management again.
Well, it's also a matter of people's choices and trade-offs and so on. Simon, quick comment, and then 2 comments, and then we must finish.
Fighting debt in England's terrible. It's a worldwide problem. People buy things and don't look after them.
Yeah. Simon?
I just want to make one comment, and that is that normally, under normal circumstances, the question of what you earn on investments is not, if things were normal in the world, in terms of where economies are, in terms of where markets are, we wouldn't be talking about it because we would get normalised returns. The number one issue facing anyone around the world, whether it's an investment manager or yourself, is that we are in an environment where we are not going to get normal returns. It is impossible to get normal returns when interest rates are zero and share markets are technically overvalued. Well, let's wait and see what falls out of that. But what you can be guaranteed of is that we are not going to get, from here on out, normal returns. So you have to take it upon yourself to be interested in that, because you're not going to get, as I say, normal returns from here.
Right.
So it falls upon everyone to take responsibility for that.
All right, Simon. Ted, quick comment, and then comment from behind, and then we'll finish.
Yeah, it just does strike me that sort of grammar school basic economics is not going to help me figure out which kind of investment to make when, like as Simon pointed out, even when you think you're on a winner with something, there are second, third, fourth order things that happen that make it the wrong choice anyway. I think all I'm going to do is buy free-range eggs. I'm sure that's a good thing. I'm sure that if I buy pork that isn't, the pigs hadn't been mean to, that's a good thing. But in terms of whether I invest in Apple or Walmart, that's too complicated, right? I'm going to be wrong no matter what I choose. I can't keep track of that. I don't know that reasonable people can.
All right, well, thank you, Ted. And final comment?
Yeah, Garry, I think you've confused money management with investment advisory. And investment advice is a profession, and people should seek professional advice, just like they should for their health. You shouldn't rely on self-diagnosis for a health issue. You should go to the doctor. You've got a legal issue, you go to a lawyer. You've got to invest money, you go to a professional business advisor.
Well, that's fine. All I was saying is that people don't have an appreciation, an understanding of money management. It's general throughout the population because it's not taught. That was the point I was making.
So one of the things we need to do is to lift financial literacy.
Absolutely.
And I'm sure the Retirement Commissioner who had that responsibility would wholeheartedly endorse that. And perhaps because we only have sort of 30 people here rather than 300, maybe that sort of says something as well. Margaret.
I was just going to say, unlike the Anglican Pension Board who do their own, looking through the books, the Presbyterian Property Trustees, we have a very wide mandate. We don't have the time for that. We hire somebody. We still have to monitor the person we hire. What I'm really trying to say is, don't feel ashamed taking professional advice. It doesn't absolve you from cheating out the professions. So all those pages and all those annual reports. You can get somebody else to do it.
Thank you, Margaret. Final comment to Mark.
And you'll guess where I'm going to go. I'm going to say that the question itself, before KiwiSaver, probably only related to 10, 15, 20% of our population. And even in this country, the majority of our fellow citizens don't have the luxury of discussing this question, and that structurally we're actually we're caught with that issue sitting right at the fundamental. So I'll just place that on the table for you to pray on.
All right. Well, look, thank you very much indeed. Sorry.
Jonathan, I just want to say thank you. You know I'm the Anglican.
Yes, I do. I do, yes. Yes. So,
yes, sorry.
No, go ahead.
There's four of us here. I thank you very much for, how should I put it, tolerating us in the seats. We do have, amongst other things, we do have a KiwiSaver fund, and we've got a few brochures here. But I'm not sure if you want to necessarily, for those on the 65, enjoy an hour in ethical investing, because if you could hear some of the full-time barneys that go on in the 5-member investment team, you might want to run an eye.
well, thank you very much. I'm very comforted that they do have arguments, because that suggests to me that they are trying to face the very difficult issues that have been raised during the course of the last couple of hours. So look, could you join with me in thanking the four speakers? I've got something to give them. I was going to bring along some of my Apple shares, but unfortunately I sold them some years ago. And then I thought, well, instead of that, I'll bring along my shares in BP. Since, Mark, you have driven all this way, I think, yes, from, so here's some shares in BP, Mark, that wonderful environmentally responsible company. I'm being very naughty here. So, Mark, thank you very much. And a little thank you to all of you for contributing. Could we show our appreciation, please? And I think we've begun a conversation that I hope will continue. So, all right. You were very good. You were very good. No, you did extremely well.
Well, Jonathan, thank you.
All right. Good.
Yes,
Likewise.
We'll see you on Tuesday. Tuesday, when we see you on Tuesday. Oh, yes. Oh, yes, we'll do. Yes. You've got a lot to talk about.